record this. So, hello, everybody. My name is Rochelle Dickerson. I'm the CEO of Rama Financial Solutions. And I was just telling some of my agents that at first I could not get the concept of infinite banking because it uses a whole life policy. And back in the 90s, I was burnt as an agent in the whole life space. I saw agents trying to sell final expense whole life, specifically globe life insurance policies as savings plans for government employees. And that gave me such a mental block against whole life that when I saw this infinite banking policy and they said that they were using whole life, I just could not see it to save my life. I had so many paradigms. But just recently, I once was blind, but now I see. And I'm so glad that I woke up and I can see and I can understand and I can explain the concept of infinite banking. Just simply, you borrow the life insurance company's money and you keep your money growing in the policy. Simple. Borrow the life insurance company as simple compound interest. Keep your money growing in the policy. Pay off your debts at compounding interest. Pay back the life insurance company at simple interest. Again, pay off your debts at compounding interest. Some of your debts are compounding monthly. I had a car note where the interest was compounding daily. Some of them are compounding at an accelerated rate so that you would never ever be out of debt. You could pay your car note for 15 years and the car would be falling on the sidewalk looking like something from the Stone Age, and you would still barely hit the principal and still because of the compounding interest. So borrow the life insurance company's money, pay back simple interest, and eliminate all the compounding interest. Okay, that's one of the concepts. But the main concept is never take your bank account to zero. So when you borrow from the life insurance company, your money keeps growing in the policy. You take their money and use their money to eliminate your debts. And your money is still sitting in your bank account, and your money is still sitting in your policy, and your money keeps growing uninterrupted compound interest. All right. So the concept of infinite banking is uninterrupted compound interest, infinite growth, infinite movement of your money. And I'm telling you something, when the light comes on and you get it, nobody can ever take it away from you. So today is my day. I tell all of my agents, own what you sell. If you don't own what you sell, then you're a hypocrite. If you're selling a policy, you need to own that policy, me included. So today is the day when I take my little bit of money and I'm going to put it in this policy and practice the principle of infinite banking. And let me tell you something. This is something I am going to use forever until the day I drop dead. Amen. I am tired of pulling all of my money out of my bank account and ending up broke, because that's the way we're trained. We are trained that as soon as you get a paycheck, you pay all your bills and you're broke. Then you get another paycheck, you pay your bills and you're broke. Pay them and you're broke. Pay them and you're broke, and you never get anywhere. Guess what? I'm going to pay myself first in this infinite banking policy, let it grow for 30 days, and then I'm going to begin to slam off all of my loans using a life insurance company's money while my money keeps growing. while my emergency funds in the bank keeps growing, and while my money in the policy keeps growing. And I'm going to continue to pay myself first and be my own bank for the rest of my life. And you can stop the video right there and call me or email me at raymafinancialsolutions.net, and we can get on a Zoom call and we can get you to pay yourself first and use other people's money to pay off your debt. Boom, drop the mic. All right, so I'm training my agents and I'm showing you as well how I'm going to pay myself first. So I have logged in to your family bank. Now, if you are an agent, you have to get a contract with your family bank to get started. Okay. And we have some amazing commission levels and override levels as well. So if you're interested in this concept as an agent, reach out to me and get contracted right away. But as you can see, I have logged onto my agent portal, and these are some of the clients that I've been working on, but you can see my information is right there. And it says more information needed, right? So what did I do? I'm going to click here. And what I have done is I have entered my debts into this algorithm. So, and you got to excuse me, you guys, because I'm a little bit new. So I'm going to click here. I'm going to click $500 a month because that is the policy that I want to start doing. And you might be like, well, how did you come up with that number? Well, basically what I did was the algorithm asked me to enter all of my debts. And I want to make sure that I have them all in here. So I'm clicking on all my debts. And what I did was I entered my credit card, my 2 credit cards, and my car note, my insurance policies, and my income. And guess what? This is incomplete because I have quite a few other debts that are not included on here. So I am going to go back and I am going to complete my debts. So I actually have a timeshare. Let me tell y'all something. Don't get caught in them daggone timeshares. I'm telling you, they are horrendous. And I want to say I owe about $30,000 on that timeshare. And I want to say the interest rate is horrendous. It's like 23%. And the payback is like $300 a month. And then, oh, see, it says when the pay, yes, it's saying that that's not a valid minimum payback. So they're saying that I think my payback needs to be, oh Lord, I think it needs to be $400. Because I remember setting up a payment plan for $400 a month for this thing. And my actual payment might be $500. Let's see. Boom. Okay, so it's funny because the algorithm doesn't play games. If your minimum payment isn't a certain percentage, it'll say invalid minimum payment. So let me just see 500. Will it allow me to do that? 500. Enter. Nope, not. 600. Oh, see? Okay. All right. Okay, so I did that. So and actually what I'm going to do is I'm going to go back and I'm going to do my research and I'm going to make sure that I have all of my debts in here. I actually have a tax liability too. And it's a Maryland tax liability. And the last I checked that liability is about $4,500. And the last I checked, I believe it was like 7% interest. So I believe that is the minimum payments were like $250 a month. And then $250 a month is what I'm actually paying. Okay, it's saying that, okay, so actual payments, just say $600, make it even. All right, so what you do when you get your client's information, if you're an agent, is of course you can see you enter the name, you enter the principal of how much they're paying, then you enter the interest, and then you enter how much they're actually paying and what their minimum payments are. And if you make a mistake, it will not let you move forward. Okay, so you enter all of that in, right? And let's just say I was overpaying something. So let's just say the minimum payment is $600 on this timeshare, but I wanted to knock them out. So I was paying them $1,200 a month. Okay, so what it's going to do is it's going to say insufficient overpayments. It's going to say that $618 a month is being used insufficiently. And when you get your report, it's going to show you how to redirect that $618 in a month to pay yourself first in a Your Family Bank whole life insurance policy in the infinite banking system, right? And it'll tell you that you're overpaying here, and it'll tell you that you need to redirect some of the monies that you're putting in. Okay, so I go up here and then, oh, wait a minute now. Let me see, I might have put it under mortgage. Let me just double check here. All right, so it's asking me to save it. So to make sure I save it. Okay, yep, then a little icon came up that said it got it. Let me see if I put it under mortgage, because that timeshare is actually property. So it has to be done. And then insurance. So I have two National Life Group policies. One, I have a $500 a month into an index universal life for $600,000. And I have one for Solomon at $100 a month, right? And then it'll ask you to get the cash value. So I need to go check on that and see how much cash value that is. And then it tells you all there. Then if you have any investments, any annuities, you put them here. And then here you put your source of income. So actually, let's see, 2, 4, 6, 8, 10, yep, about 10 to 15,000 a month is actually a pretty good estimate. And then what you do here is hit summary, right? If you make any mistakes or your clients has something else that they need to add on there, you can put it on there. So for some reason, it put it on here twice, $30,000. This is looking kind of funky. I don't know. Okay, 10,000 a month. Oh, huh. It entered the tax liability twice. It entered the, I don't know, 83,000. So, but what it is, I think there's a little glitch in here, and I need to check that out. But it adds up how much principal, it adds up how much interest, then it turns the interest into a dollar amount. And that's what the algorithm does. So it's saying that my principal is $83,238.32, but my interest is an extra $28,369.55. So it adds up a dollar amount for your interest. And then it's telling you how many payments it would take to actually pay that off if you add the interest into it. And it tells you how many years it would take to actually pay that off if you added the interest in, right? So it does, the algorithm does all of that for you. And then, okay, then it will put it all in a computerized report. Here, you can tell it what carrier you want to use in order to structure the policy to pay off debt. So there are several different carriers that you can program. And what it will do is it will program how much cash is going to be in the policy and put it right beside the carrier that you're going to use. And they will structure the illustration for you and upload it onto this report. So let me just give you an example. Okay, so this is the report for me, Rochelle Dickerson. It has your National Insurance Producers Registry number on there and your email. So when you go back and you visit your client, and you entered all of this into the algorithm, this is what you'll sit down and show your client. So it'll talk about the problem, which is what I described to you. The problem is that we save money and then we spend it all on a debt. And we go, and our bank account goes back to zero. So we get our paycheck, we just pay out all our bills, and then our bank account goes back to zero over and over again. Or we get a credit card, we spend it all up, we charge it all up down to zero, and then our bank account goes to zero, and then we pay our card back. So we're either borrowing money and going back to zero, or we taking our spending. But the common denominator is that we keep going back to zero. So it's saying that my current debt is $83,238. That is my principal. But when you add the interest, my current debt is $111,607.87. It's saying that at that rate, it would take 7.6 years for me to get out of debt. I would right now doing what I'm doing, I would end up paying $28,370 in interest. That is how the banks make their money. That spread, we call it a spread between what you actually owe and what they charge you in interest. So the bank makes $28,370 off of me with the interest that they charge. Listen, when you show your clients that, that is a wake-up call. Once you see it, you can never unsee it. Right? So that is the biggest reason why you want to get out of debt. All right. So then it does a little bit more of a breakdown here. And of course, there's a few things that I'm going to have to fix because it came up twice. But it's saying that it added it all up, but I'll go back and edit that to make sure it doesn't come up twice, right? So it said $28,370 in interest, and I'm averaging 25.42% in interest. So it says, how do banks make money? The bank takes your deposit. You go deposit your money into the bank. The bank takes your money and loans it out as much as 7 times. So let's say Rochelle puts $5,000 in the bank. The bank takes Rochelle's $5,000 and loans it to Donzella and charges her 15%. Then loans it to Jeff and charges him 7%. Then loans it to Shalonda and charges her 12%. The bank loans my money out 5, 6, 7 times and charges interest on every single one of those loans, putting your money to work 5, 6, 7 times. And they make their profit off the interest. So just like you saw that $28,000 in interest, that's the bank's profit margin. So why don't you be your own bank? How do you do that? You redirect insufficient dollars and put it into an overfunded whole life insurance policy and give every dollar at least 2 jobs. Actually, it's going to be 3 or 4 jobs, but at bare bone minimum, give your dollars 2 jobs. What are the 2 jobs? You're going to give your money. The first thing we're going to do is protect your life so that if you died, you would pass on a large tax-free lump sum of money to your family. The third job we're going to do is cover you for sickness and disability. So if you got sick or hurt, terminally or chronically ill, that death benefit is going to turn into a large sum of cash that will be paid to you while you are living. The third job, which I'm correct in this portal here, because it's 3 jobs. The third job is we're going to take your money and we are going to eliminate your student loans, credit cards, your car note, and your mortgage. Boom. So we are going to make your money work for you 3, 4, or 5 times. Now, this could actually have some extra work here because you're going to get life insurance, living benefits, and growth interest. So if I were redesigning this portal, I would have life insurance, living benefits, dividends, and debt elimination. So this actually should be 4 jobs. You are giving your money 4 jobs. Oh, it does have dividends, but that should be a job. Anytime your money is making babies for you, then that is actually a job. Okay. All right. So how does this stack up? Can I do this myself? No, you cannot. Because the only way you could do this is to have the ability to use somebody else's money. You have to keep your money in the bank and use somebody else's money to pay off your debt. So can I do this with my 401k? Heck no. 401ks are money jails. They lock your money up until you're 59 and a half years old, and they make you borrow your own money at a variable interest rate and huge penalties. Can you do this with the stock market? Heck no. The stock market, you will lose your money every time. And you can't use somebody else's money. That's your money. So all you're doing is going back to zero. So taking your money out. Can you use it do this at the bank? No, because all you're going to be doing is using your money and taking your bank account back to zero. Can you do this in a whole life policy? Yes, because you will be able to use the life insurance company's money and keep your money growing in the policy. You'll be dead. You'll have accessibility after 30 days. You'll have access to your money. It'll be penalty free. It'll be guaranteed growth. Whole life has a guaranteed interest rate of 4%. And when the company's assets go up, you'll be paid a dividend. Your dividend can be 5%, 6%, 7%, but it would never go below 4%. The reason why people like to use whole life is because whole life has an above average guaranteed interest rate. Is it risk-free? Absolutely, because your money is not on the stock market. Is it tax favored? Yes, because you will be borrowing money and loans are not taxable. Are you leveraging? Yes, you're borrowing the life insurance company's money and keeping your money growing in the policy. All right, so that is the verbiage and this is the presentation. So again, how does it stack up? So this again is, it would take me 7.6 years to pay off all those debts. But your family bank way, I'm going to pay off those debts in 3.6 years. How you like that? $100,000 worth of debt, setting aside $500 a month, and using this technique, I will be out of debt in 3.6 years. I will eliminate $16,463 in interest, and I will free up $2,729 in cash flow. What does that mean? Instead of paying $375 to the car note, once my car note is gone, that $375 comes in my pocket. That's cash flow. The potential savings, instead of paying them, I can pay myself first and grow my money so that in 30 years, taking that same $500 a month I will have 1.2 million, 309, over $1.2 million in tax-free cash set aside in this policy. And if I die, this policy will grow and I will have $1.2 million paid to Solomon and my mom if she was still living. All right. So again, recap. Get out of debt in 3.6 years or pay all that interest and get out of debt in 7.6 years. End up paying 44,832 versus $28,369.55. Liquidity, $165,015. So in the 7th year, I have over $165,000 in cash value, and my death benefit will be worth over $272,919. This is the wave of debt repayments so that's saying this is how you do it. Drop all your payments down to the minimum. Pay off your first debt right away. Pay yourself back. Once you pay off that first debt, the money that you would have paid that debtor, pay yourself first. So pay yourself back into the policy and increase your assets, increase your cash flow. Then roll it up towards your retirements. Keep setting money aside. Build momentum. Watch all the interest evaporate off of all those loans. And then the debt elimination tsunami. Building building to crush the biggest debt. So the biggest debt will be the last debt. You will wipe it all out in the middle of the 3rd year. All right. So I like this little slider. So as you can see me sliding, it tells me when I'm going to pay off the first debt. So it's saying let's see, when? We just do it a little slower here. How about we do this? Okay, so it's telling me that putting in $500 a month, it is telling me to wipe out the first 2 credit cards the first month, and then the second credit card with ending in that the second month. So it says so I will have this policy for 30 days, and then I will wipe out the first credit card. Then after I've had this policy for 60 days, I will wipe out the second credit card. And then it moves on and it says I will wipe out the 3rd debt in the 6th month. Okay, and then I will wipe it out and wipe it out and wipe it out. So the algorithm tells me when to go in the policy and eliminate each debt. And all I have to do is follow the blueprint, and I will be debt-free in 3.6 years. All right, life insurance that covers every circumstance. So it's telling me put in $500 a month. I can take out a loan in cash value. It's telling me by the time I'm 76 years old, I have over $94,652. And if I live to see age 96, I'll have $140,000. If I become ill, it has living benefits. So I have access to the cash value, and I can surrender 80% of the face value of the policy if I was diagnosed with cancer or heart disease or stroke or kidney disease. And if I die, Solomon will get a really nice lump sum of money from this and from the other policies that I have. So how can you ask for any more than that? So many benefits through your life. It's telling you all the different things that can come up where you need money. So you'll have guaranteed emergency funds, liquidity and control of your money, access to the cash value without penalties, tax favor growth, flexible premiums, which means I can start at $500 a month, but if I get in a jam, I can drop it to $300 a month. And if I want to do it quicker, I can increase it to $100 a month. Self-financing future purchases. So instead of going to the bank and borrowing $100,000, I can go into this policy and I can leverage my death benefit. And if I can't pay back the 100,000 or 50,000 that I borrowed from this policy, they're going to leverage my death benefit, which means they're going to decrease it out of my death benefit. Instead of affecting my credit, instead of taking money out of the bank that I need, if I can't pay back the 20,000 that I borrowed from here, they're just going to decrease it out of my death benefit. So I'm using my death benefit as collateral instead of using my money in the bank as collateral or risking my credit report. Y'all picking up what I'm laying down? Improving your cash flow by getting rid of all that interest. Earn interest while you are paying off your debt, so you never stop earning interest. No loss of your principal, so you're not risking your money on the stock market, trying to grow it out there, and then all of a sudden you look up and it's gone. It's safe from market fluctuation, and it's self-completing death benefits. So if I die and don't make it, that money will go to my family. And if I get sick or hurt and diagnosed with something critical or chronic, it's self-funding. So I can file a claim and get a large amount of money if I can't put any more money in there. I mean, it's mind-blowing. All right. So what did this do? Identify money that is not working for you. Capitalize it. Ability to take loans. Be your own bank. All right. So I'm going to skip over all of this. I don't think all it's doing is just kind of repeating itself. Yes, I do want to get out of debt in 3.5 years and not 7.5 years. I'm too old to be waiting 7.5 years. And then this is the grid. So those of you who are in the life insurance industry, you know that you have a money grid. So when you do a proposal, it tells you when and how you're taking money out. So this was matched with mutual trust. It's saying if I am at age 56, I would have put $6,000 in there. I'm going to have access to $3,508 and a death benefit of $87,765. The first year, I'm going to take out $3,800 and I'm going to eliminate that debt. And then I'm not going to be foolish, but I'm going to pay myself back. So the $100 that I was paying those credit cards, I'm now going to increase my $500 a month to $600 a month so that I can continue to grow my money quicker. It's called the debt roll up, except you are not taking your bank account down to zero, as Susie Orman and Dave Ramsey said. Because if you do it their way, you're going to be taking money out of your personal money out of your bank account. And every time you pay off a debt, you're going to be starting back at zero. But with this, you never start back at zero. You're using a life insurance company's money and keeping your money growing in the policy and then keeping your money growing in your bank account. All right. So I'm leveraging these loans here and it's telling me how and when. And it's telling me I'm going to end up taking out a total of $10,800 and eliminating my debt. And when I'm 59, all that stuff will be gone. Okay. And it matches the structure of the whole life policy to do that. Look at that. All right. So, any questions about that? All right. So I'm going to go ahead and finish because I've got some editing to do. And I am going to do what? Buy the policy. I am putting myself first. I am paying myself first. For way, way too long, I've been taking my paycheck and paying off all these debts and never seeing the light of day. I've had that silly car. I bought that car in January of 2019. And to this day, it seemed like that principle never moved. The car is leaning on one side. I've gotten so much stuff fixed. and I still owe them thousands of dollars. So it is time for me to redirect and let the life insurance policy pay them, and I keep my money growing. Yep. And get rid of them as soon as possible. What about you? So I'm starting today. I'm finishing this application today. If you took a look at this and you believe this is going to help you and your clients, it's time for you to get contracted. The contracts are high and sweet. The bottom contract is 70%. Okay. And then there's spreads and overrides for the agents that you take in. And the education you cannot get anywhere else. There's no other IMO that is giving you this infinite banking education. So if you are hungry for the education and you are hungry to make sure you use a policy like this on people who are in pretty good health and people who can put decent amounts, $200 or up, the average policy is $300 a month. That's the average small case. The algorithm tells people how much they need to put in, and it gives them choices. They can put in the smaller amount or the larger amount or somewhere in between. So the algorithm does the budgeting. All you have to do is show up and click through the presentation just like I did. And then if you just say the words. Does it sound like a good idea? Yes. Let's get started. You're closed. Let's get started. All right. So I'm going to sign off and I'm going to get myself started. I love you and I pray you get started with me. Don't get left behind. See you soon.